Good morning. This is Ken Long from Tortoise Capital Management with a review of charts of interest for May 15th, 2011. There's no need to look at the Renko charts this week. The sideways action in the indexes and large caps keeps everything pretty much within the previous week's ATR range, and so we'll just look at the candle glance version on stock charts, looking at a 2-month look back on daily candles with a 20 and a 50 period moving average indicated, and looking at the MACD histogram with the standard parameters below it. Okay, so Alcoa held above the 20 and the 50, flat and sideways. It's holding up pretty well compared to the other commodities. Boeing has been exceptional, and it is digesting here. I like the support that's in about at 78.5-ish. Caterpillar just shows the declining weakness here now. Had a higher high and now a series of 2 lower lows and breaking through the 50. Now, if it can hold here, where previous support held at 105, then this makes a nice channel on what had been a strong leader. That's one that's I'd be worried about a breakthrough below 102. But as long as it's above 105, I think momentum can be rewarded, and that can turn pretty easily into a swing trade because you can see the channeling and trending nature of Caterpillar here. Cisco shows its typical trending behavior, horrible sell-offs, finds support, climbing the wall of worry, and then the big gap down near earnings announcements. This looks like a max pain range compression with an inside day doji on the last one, a break north of 17, and I'd be looking for a target of about 18. So that's a potential on a tactical trade, but I want to see price evidence first. Chevron has sold off like the rest of the energy sector, but finding support north of 102, channeling trade now between 102 and 110. Agriculture may be finding support here, but at 32, but that's pretty close to the edge. A 32 to 35 gives us about a 9% channel to work with, and that's got some potential. Double bottom perhaps in the blended commodities. That's going to be a function of the large energy component. So if it can find support here at 28.5, now we have a return to 31, which is about a 10% potential channel. EFA selling off on weakness in the euro. And testing the 50 right here is going to be really crucial about what that index looks like going forward. Double bottom in EPP, it's got a hold, but with all this negativity in these large indexes right now, it's not looking good for the global indexes. Brazil violated its double bottom. I'm looking for more weakness in there. We saw Latin America as one of the 2 weakest in ETF2, so that's not surprising. I'm looking for more weakness there. Hewlett-Packard found and held support around the 20 and the 50 just fine. If it can break north of 41 and then 42, it's off to the races on strength and technology. Latin America, much like forward here now. Intel testing its double top, had been a leading strength, leadership and strength in technology sector. Small caps have been the weakest of the U.S. sectors. You can see it doesn't look as promising as the mid caps will down here because it's already violated the 20. However, it's looking better than any of the globals, so there's some potential on a move from about 83 to 87 inside the channel. If it breaks north of 87, then it's looking really strong. Johnson & Johnson, Kraft, Coke, McDonald's, and Walmart, that cluster of 5 defensive plays, large blue chip companies, all executing really well. That sort of reflects the flight to quality in terms of staples and retail and U.S. large caps. Any one of those 4 is looking good. McDonald's especially, I mean, that's the stairway to heaven. And it did not sell off on Thursday's big move up. It consolidated near the top. I'd be looking to reward more momentum there. So I think you could do a lot worse than focusing right now on Johnson & Johnson, Kraft, Coke, and McDonald's and their buddy Walmart. The fear and volatility in the market, testing lows down here at VXX. This would be a place where it's reverted before. However, again, I want to see that happening before I jump on it. Oil and silver both finding support at these local levels here. Silver much more volatile than oil, which has a clear fundamental case for why this is a good place to be buying it. And then our last, sneaking down to ExxonMobil, looks a lot like Chevron. So I think what really stands out to me is the strength in the U.S. and technology, and those four leaders among the large caps, and then just all the globals really testing double bottom support levels. And if they fail there, then I'd be looking at EEV as the double inverse emerging markets ETF to play any short-term negative momentum. There's a pair trade suggested in there by going short the emerging markets and long the U.S. large caps or technology, so long QLD and short inverse emerging markets. It looks like a natural pair trade as well. So this is Ken Long from Tortoise Capital with the charts of interest.